Hey everyone, I'm Scott Cunningham, aka Scottsy Business, and today we're going to be talking about investing psychology. We're going to be diving into all the emotional traps, biases, all these different things that affect your investing decisions. Mostly, if not just all these different things that affect your decision making in general. When it comes to finance, a lot of these psychological traps and biases and fallacies and all these different things that come into play, almost all of them are against you, making it harder for you to invest rationally, making it harder for you to invest logically and most effectively, which is based off of logic and being rational. But most people end up sadly investing based off of their emotions and off of the many things that we're going to be covering today. So at the very least, you want to be aware of these things. Beyond that, you want to know the nuances of how to combat them, essentially. But really, the easy solution is just education. Learning as much as possible. A lot of people have the Dunning-Kruger effect where they start investing, they make a little bit of money, and they think they're a genius. So we're going to be diving into all this stuff. It's very, very important. I spent an insane amount of time and research on this. So please, if this is beneficial to you, please do like, subscribe, all that good stuff. 90% of this was taken from Investopedia, so huge shout out to them. I think it's probably one of the best learning resources for learning about investing, and their section on market psychology and behavioral finance is extremely enlightening. And a lot of what I'm taking here is summarized from that, and I'll just be going through all these different things so that you don't make any of these mistakes, and that at the very least you're aware of how these things will affect your investing, because I truly believe that the best ways to invest isn't necessarily, finding the best stock or the best crypto. It's more about your financial practices, like before you even really start, right? So budgeting, being good with your personal finance, being frugal, and then this is understanding your own psychology and how it applies to investing. So understanding something like this, I think, is probably one of the most important ways to prepare yourself for investing. And I would say this is a must read for anyone getting into investing, stocks, crypto, anything like that. Whether it's my summary or the actual Investopedia, the entire thing, I think this is one of the most important things you could possibly look at and understand when you're getting into investing. With that being said, let's jump into it after a quick word from my sponsor. If you're into crypto gambling, check out bc.game. They have a great referral program where you can get $100 per referral and up to 50% commissions. And they have a really cool lottery where you can win up to $100,000 every single day for just 10 cents a ticket. Just before we dive in, I just wanted to quickly bring this up just to show you what I was talking about for Investopedia. I've linked this as well in the description, and you'll have that there in the description below. It's very, very comprehensive, very, very effective in the way they explain it. They've got videos, key takeaways, very, very good. And it's pretty short, so I highly, highly recommend it. This probably will only take you an hour to 2 hours to read, or you can watch this video, which is going to be somewhat long, but if you'd rather just listen or watch along, then this is how you can do that as well. So let's jump into it. This is essentially, again, taking everything from that website and just summarizing it for you, and being succinct as possible to just mainly focus on the caveats and various things that you need to be aware of for your own investing. So let's jump into it. The first one is the sunk cost fallacy. Many of you probably have heard of this before. This is much more familiar because this doesn't only apply to investing. This could be your time, energy, money, or just any kind of value into anything. So for example, it could even be a relationship, like you've sunken so much time into a relationship. But the sunk cost fallacy is essentially that you've put so much effort, time, money, whatever into something that it's better for you to continue doing that because you've invested so much that maybe it will pan out. So for example, in a bad relationship, one or both of them might believe that if they just stick it out, it might get better. And they've invested so much into it that they'd rather keep going than quit. In the investing world, the sunk cost fallacy looks more like you double down on your investment when it's down 50% in hopes that that will get you back up to being even again. And because you've been in the stock or the crypto for so long and you've already invested so much, you don't want to get out. So instead of getting out, you double down. This is somewhat similar to loss aversion, but we will cover that in a bit. Mental accounting behaviors. This one is a little bit harder to grasp, but I think this is one of the most important ones out of all of the things that we're going to cover today. But it's a little obscure, so, bear with me. So essentially, mental accounting behaviors is people will value money differently, and typically they'll do so based on arbitrary criteria or subjective criteria that ends up being detrimental to their finances. A great example of this is when you receive a tax return, you treat it as found money. Like, oh, this is money that I've got and I can do anything with it. This doesn't count as part of my normal funds that, I would say, 20% goes to saving, 30% goes to investing, the rest goes to budget. No, this money is just anything. I can do whatever I want. That's not treating money as the same. All money should fall under your umbrella of budgeting. This goes here, this goes there. All money should be treated the exact same. Diving into this even further, people might look at, an investment account or even just a savings account, right? And they might say, oh, well, it's good to save. So even though they've got a high debt, high interest debt on a credit card bill or something that they need to pay down, and they're going to incur more interest by not paying that down than they are from earning from the savings account. But they say saving is good. So they put some money in savings instead of paying down the credit card debt. Again, it's just more so based on your own subjective interpretation of where the money should go versus logically where it kind of has to go. Because if you have a high interest debt, your money should all of your money should be fueling into that to pay that down. You shouldn't be taking some extra money aside and just putting it aside for a rainy day fund. No, you need to pay this down as soon as possible. It's hurting your credit. It's incurring more interest. This is not good, right? And there's a bunch of different examples of this, but an easy way to make this a little bit more relatable, I find, is people will say things like, oh, it's only X amount of money. It's only a coffee a day. It's only such and such. I can make that in one day. That's only 4 hours of work. So, whatever, it's 4 hours. They find some weird way to just rationalize it away. Yeah, no, that's 4 hours of work. The same 4 hours as any other 4 hours of work. So it should be treated the same. That 4 hours matters just as much as any other 4 hours, not just, oh, it was just 4 hours of work, so it's fine, whatever I do with that money, who cares? No, everything needs to be treated the exact same and fungible for you to not get into this weird headspace where you're treating certain money differently and you're like, oh, who cares? I can just spend this money. This doesn't matter. And this will go to the wrong thing, and etc. So it's a little hard to understand mental accounting behaviors, but it's really just that people look at different pools of money based on maybe where it's coming from or whatever, and they treat it all differently. The easy way to solve this is you treat all money the same. If you get any money, it goes into your budget and you figure out where it needs to go. Any money, right? I earn money from betting $5 against one of my friends in a basketball game. That goes into my budget. Nothing is left out. It's all included. It's all treated as the same. That $5 isn't just, oh, I'll spend that on whatever. No, it's the same as everything else. I don't get to just add to something on my budget or whatever. No, it's all included. That's how you need to do it. Overreacting and underreacting. This is pretty straightforward, and pretty much explained just in the name, but it's just having an emotional response to something in the market where you either overreact or underreact. For example, cryptocurrencies go up and down 5%, 10%, 20% even. So say your crypto goes down 5% and you overreact and then you just sell all of your crypto. That's an overreaction. This is pretty simple. I mean, there's no obvious way to get around this, but understanding the things that you're in and having reasonable expectations tied to the results in that space. I mean, obviously, if you're going into crypto, you should understand that it's going to be extremely volatile, and this isn't abnormal by any means. Irrational exuberance trap. This is where investors believe the future can be determined exactly by the past, and they act as if there's no uncertainty. So basically every technical analysis day trader. I have a lot of friends who got into investing and then they were making good trades and stuff. But then they basically got it into their head that like they could never lose. And they were always making the right trades and they were never going to make a bad trade. That's the I don't know if it's covered in here otherwise, but I've always called this like the genius effect, where you start doing really well and then you just assume that it's going to keep happening and like you're just amazing at trading, and it has nothing to do with like being lucky or being a bullish market or whatever. I think that's a huge trap that people get into, whether it's through technical analysis or something like that, or it's just based on, them doing really well and then they get confused. The best way to get around this is to just be humble and understand that no one can tell the future, right? Pseudo certainty. Investors are more likely to take on additional unnecessary risk when their portfolio is performing poorly and trending down, or less likely to take risks when they're performing well and trending up. So for example, your money, like your portfolio is doing really bad, everything's dipping, and you're like, screw it, I'm going to go into this really risky thing because then maybe I could make back all of my money. On the other side, my portfolio is doing so well. I could easily do this like not even very risky stock investment, but because I'm doing so well, I don't want to, jeopardize how well I'm doing, and thus I'm not going to invest in this riskier thing, which may end up hurting your overall portfolio, because you might have normally done that, but because you were doing so well, you didn't want to jinx it. And you played it too safe, because playing it too safe can actually make you lose out on opportunities and gains and stuff as well. So it's always the happy medium of the two. And by the way, none of this is financial advice, since I haven't claimed this yet. This is financial entertainment. And I'm just really summarizing what is already out there on Investopedia, and you can check that yourself. Now, to the blindness trap. This is essentially the opposite of confirmation bias, which we will cover. But this is where you avoid new information, or just you're avoiding any bad information. Even if you know it's true, you're just blind to it. Like you're so deep in, you've drank the Kool-Aid, and there's no getting out. You're just going to avoid everything bad and just read the good headlines. I mean, to some degree, if you're doing this, you should know that you're kind of screwed at this point. And that you should be getting out. But, people will do this. So it is a thing that happens. The casino mentality. If you come into the market believing it's like a casino, which a lot of people are doing nowadays, where you could lose everything or make a ton of money as long as you're willing to, take good and bad bets, you're already setting yourself up for failure by looking at the market this way. Gambling, by definition, is wagering money with no skill with an expectation of a negative return. Investing is utilizing money to continue growing your wealth in the future with an expected positive return. Now, there's only a slight difference there, and it's your expectations. If you're going in and you're throwing random money at random cryptos and you're basically gambling, because that's what it is, you should expect to lose money. If you are expecting to gain money, you're already screwed, because you're gambling and you're thinking you're going to make money. If you're investing, You're not just randomly investing. Someone says, oh, this coin's going to 100x, you invest in, like that's all gambling. If you're actually looking into things, doing deep research, coming to the conclusion after a while that this is what you want to get into and invest in, I would say that's more investing. And you're in it long term. You're not just going to sell in the first drop or in the first rise, etc. That's what most people end up doing for when they're gambling / speculating on altcoins or shit coins and stuff like that. The time-tested theory, money flow analysis suggests a large portion of market participants buy at the top and sell at the bottom. So obviously the opposite of what you should do. Also, when markets are hitting peaks or valleys, buying and selling are at their highest. So most people are buying at the top and selling at the bottom because what happens is there's all this hype. Everyone's saying this is the most amazing thing. It's never going to go down. And you say, nah. And you just keep hearing it every day going up and up and up and up and up. It's all over the news. Finally, you say, you know what? I can't miss this thing. I'm going to get in. The next day, it tanks. And then you say, well, damn. So this thing isn't legit. And you're like, okay, maybe I'll hold on a little. Maybe I'll hold on a little. It keeps going down, 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 down. And you're like, no, I'm selling out. I'm just taking my losses and calling it a day. And then right after you sell, at the bottom, it starts going back up again. And then you're just sitting there like dumbfounded, like, what did I do wrong here? You bought at the top and you sold at the bottom. The only reason you did that is because you didn't really know what you were buying and you didn't have conviction in what you were buying. You were just buying something randomly. And because you didn't have conviction in it, the first time it dropped, you sold because you didn't actually have conviction in the investment. Simple way to avoid this is to just invest in things that you actually believe in, that you would buy the dips on. It's as simple as that. If you wouldn't buy the dips on whatever you're investing in, you shouldn't really be investing in it. And I think that's a very easy way to, to decide whether or not to invest in things as you're going through the many, many opportunities you will be presented with. Limited attention span or bounded rationality. You will make decisions based on limited knowledge that you can collect to make the most satisfactory decision, not the most efficient decision. Because again, most people aren't going to do any of the research. They're going to probably decide whether or not they're going to invest. I would say generously in 1 day of research, most people will decide in 1 hour. I would argue most people are in the second they hear this amazing opportunity, they're hooked. So you can only really make decisions based on limited knowledge a lot of the time because people are not going to go and do all that extra research because we're inundated with offers and we wouldn't be able to do all this research. Trend chasing. Now, this is pretty obvious, but the University of California found investors who weighted decisions on past performance, as in looking at trends and then being like, okay, this is what's going to happen based on that. They had the worst performing portfolios. Humans can easily detect patterns, and often when we find them, we believe we believe in them. We feel that they're valid because, it looks like a trend. But that's what humans do. We identify trends. So you will identify things regardless if they're accurate or not, and then you will believe that it's valid because you just discovered it. Often these patterns are already priced in and not as impactful as we believe. So the people who are doing the research and are doing all this effort and studying and looking at the things and they're really in the space, they probably know all of this. A lot of people have probably priced in a lot of the stuff that you might think is super impactful and it's not as impactful. The easy way to get around this is to just do your research, be very mindful of what's going on. And like we said before with the pseudo certainty trap, with the irrational exuberance trap, you should not be investing based on the past. This is somewhat similar to that. Loss aversion, fear of regret, prospect theory, it's all the same thing. This is kind of similar to the sunk cost fallacy, but it's a little bit different. So I'll explain the caveat here. This is one of the most important behaviors to understand, I feel. It's where you put more emphasis on your concern for losses than the pleasure you gain from a gain. So for example, you would generally be more upset about losing $100 than how happy you get from gaining $500. Now think of that. That's a 5x. So you should be, logically, 5 times as happy as you were sad. But this would suggest that even at a 5x, you're still going to be more upset about that $100 you lost than the $500 that you gained. Because then you'll just be sitting there and you'll constantly be remembering, and but I could have had $600. But I could have had $600. So it's not always even what you gain or lose too. It could be what you could have gained, right? For me, I find this to be one of the most true things for psychology ever, because when we got the ENS airdrop, I got about $15,000 for free. I should be ecstatic at that. And I was, until I realized that had I waited 24 hours, I could have sold that for $34,000, more than double. And now, even though I made 15 grand for nothing, that's a dream to most people, I cannot get over the fact that I could have had 34,000 and instead I only got 15. I can't get over it. It's very, very true that this affects you much more than the other way around with how much you actually gain. So even myself, I know this to be so true, and I've felt this time and time again myself. So to avoid losing, you may risk even more money on a bad investment. Research shows that traders were 1.5 to 2 times more likely to sell a winning position too early and a losing position too late. So what this means is, because you're afraid of missing out on future gains, you don't sell when you should sell, because like you've got all this profit, but then you're like, but I could get more. Like myself thinking, but if I just waited 24 hours like that one time I could have, it might double. And then you get that into your head, and then you start doing foolish things. You sell winning positions too late. You sell losing positions too late. So like your stock or your crypto is going down, and you're like, like maybe it'll go back up. I don't want to realize this loss. And it keeps going down and down and down. And then finally you say, fine. I'll sell. And you take the loss way later than you could have when you identified this problem originally. And that's kind of the whole idea of fear of regret or loss aversion. The idea, or prospect theory, and the idea of prospect theory says is investors value gains and losses differently. They always place more weight on the perceived gains versus perceived losses as well. So this is a little bit different, where it's talking about like, if an investor is presented with a choice and they're both equal, they'll probably pick the one presented in terms of potential gains. So this is more, the prospect theory is basically the same as loss aversion, but it's talking more based on perceived gains. Like if someone's pitching you something or whatever. So it's a little different, but also similar. So I kind of clumped them all together. But yeah, the best way to get around this is to just understand that you will feel this way and operate with that, knowing that is the case, and just being very, very mindful of that when these things do happen. When you feel really upset about a loss, you always got to come back to the fact that you know you'll feel worse about this than it really is. And just reminding yourself that like you've gotten really good gains, and even though you don't appreciate them as much as you should, they are better than you're really giving them credit for. So you've just got to make sure to keep that in mind. This is more of a stress management, like mental management type thing. Confirmation bias. You're more likely to agree with information that confirms your beliefs and seek them out even if they're flawed. This is pretty straightforward. Like, instead of searching what is the inflation rate for, whatever, you might type in, is the inflation rate 5% or whatever. So you'll start doing things in a way to try to get the exact information that you want to see. And then you might see one that says, oh, it's 2.5, and you just ignore that and you go down until you find the one that you agree with. And then you'll just seek out things that you agree with. And then eventually you'll be like, I have all these things that I agree with and agree with me, so I'm probably right. But there could be 10 times as many articles that disagree that you've just ignored. Similar to the blindness trap that I talked about earlier. Familiarity bias. You tend to invest in things you know or are familiar with. This can actually be really good because you're more knowledgeable in, if I'm investing in tech or, internet related companies, blockchain, crypto, I'm much more knowledgeable and I'm more likely to invest in this stuff because I'm familiar with it. However, this can also lead to being under diversified. Like you only invest in one sector, that sector tanks. Regardless of how knowledgeable you are, you lose a lot of your money because you are under diversified. So that's something to keep in mind. Anchoring behaviors. I really like this one because I think this is very relatable. This is having a bias towards an irrational or arbitrary benchmark figure. Now that is a very roundabout way of saying you make up a number in your mind and you decide that's when I'm going to sell or that's when I'm going to buy. And then someone says, well, why'd you decide that one? And you just say, well, whatever, like arbitrary reason. I want it to be $1,000 because that's a good round, even number. I won't do it at $9.99. It has to be $1,000. And then it goes to $9.99 and then it tanks and you didn't sell because you needed that one extra dollar. I think that's a good way of explaining it. But essentially, it's just you get this idea into your head that this number matters, even though you just made it up arbitrarily. And you're essentially tricking yourself into believing that that matters. And most of the time, because of this, you end up getting a worse deal than you would have otherwise. A good way to understand this in real life is when you go to a grocery store and you see a small item is on sale. And you say, oh, that's so great. It's on sale. But you fail to realize that the bulk item, which isn't on sale, is still cheaper than the small item on sale. Meaning that you're getting caught up in these arbitrary numbers, right? Because you see, oh, it's on sale. It's like a better looking price. That's a more optimal looking price. So I'll go for that. Anchoring yourself to the idea that the sale is the better value without realizing that if you actually compare them, the bulk one is the better value. You just anchored yourself to that. Now, it's not the most amazing way to explain it because that's more about everyday stuff versus creating arbitrary numbers when you're investing. But that was kind of what I thought of when I originally was thinking of an example. In real life, obviously, it's like you've got a stock, you have some random value, you don't know where it's going, but you decide that it's got to hit a specific point just because you like that number or whatever, and you're not going to sell until it hits that number. That's the average example. Social factors. Social relations play a huge role in how we invest. In a study, it was found that when making decisions on behalf of those you're close to, you would invest with 1/3 less risk, and even more so with investments accounts that have labels like retirement or college fund. So essentially, all this is saying is when you start bringing in things that make it a little more human and relatable, like if I've got a retirement account, I'm just naturally going to be less risky with that and, take a little more care with that. Or if I'm investing on behalf of someone else, I'm going to be much more careful, which you should always be. And I think this is a great way to frame things, whether it's investing or anything. A lot of people would say, typically people are overly negative towards themselves. And they say the way to get around this is to treat yourself like someone you were caring for. So for example, if you screw up and you have negative self-talk and you say, oh, you suck, you're the worst. It's like, well, would you say that to your child or your elderly parent that you're taking care of? Would you scold them for screwing up or whatever? And if you wouldn't, you should be treating yourself the same way. That same thing would apply to investing, as if you were investing on someone else's behalf, but instead invest as if you're investing on behalf of someone, but for yourself. That's the best way to combat that, essentially. Self-enhancement. This is similar to the hot hand fallacy, which we will cover in a moment, or self-attribution, which we will cover in a moment. But it's essentially that you tend to take more credit for your successes than you will credit to luck, other people, or other variables. Sort of similar to what I talked about at the beginning, where people think that they're a genius because they're making good trades, even though, the market is bullish and basically every trade that everyone makes is making money. But then people are like, oh, well, I'm so good at trading, da da da. It's like, well, you're trading in a bullish market and you're getting lucky on your picks. It's not like that big of a deal. So people will tend to credit themselves more for their successes. And another reason why this is bad too is because you might invest in a terrible investment. It might work out. And then you're going to go around saying, well, I'm really good at investing. Look at how good this worked out. I'm going to keep doing this, even though it was a terrible idea and most of it was just you getting lucky. But because you attribute it to your own genius, you're not really learning from that experience. Experimental bias, also called recency or availability bias. This is where people place priority on recent events or new information. They may also believe that this is likely to reoccur. This is like, you see news headlines, right? And people base all of their thoughts on the latest headline. I know a lot of people that are like, Bitcoin and Ethereum is the future. And then the first headline they see that's like, it's tanking. They're like, oh my God, should we sell? It's going to zero. That's the experiential bias. Oh, I think I said experimental at the beginning. But yeah, experiential bias or availability bias. You're just putting all of your priority and emphasis on recent events and news. So if something good happens, you're overly, gung-ho about it. And if something bad happens, you're overly reacting in a negative way and you want to like sell out everything and all that kind of stuff. So do not place all of your emphasis on just the latest news. That doesn't overshadow, the underlying fundamentals and previous news and all that kind of stuff. Relativity trap. The relativity trap is a behavior or bias that leads you to make an irrational decision. This is just a general explanation of kind of most of the stuff that we're talking about. All of these things are generally relativity traps. I mean, aside from certain things like behaviors and certain things we've talked about, but all the like traps and biases we've talked about are all essentially relativity traps. So you could summarize all of these up as that. That's really all it is. It's just the term to talk about all of these terms. Herd behavior. People tend to do what everyone else is doing, and they have fear of missing out on those perceived opportunities. So that's why, as I explained with the money time tested theory, that most people end up buying at the peak and selling at the bottom because they're just following the herd. The best way to get around this is to not just do what everyone else is doing and make investing decisions based on all the information you have and what is the best option at the time for you, not what everyone else is doing or what they think is the best for them. And that's also how you get things like Shiba and Doge and all that stuff. And then they completely fall off the map because it's just whatever everyone is doing. And most people lose money this way too. Emotional gaps. Making decisions based on extreme emotions leading to irrational choices. Very similar to a lot of the stuff we've talked about. This is pretty straightforward. It's just don't get caught up in your emotions. Don't panic sell. Don't panic buy. Don't FOMO. All that stuff, right? Hot hand fallacy. We mentioned this before. This is like the old gambling fallacy where essentially you think because you've had a streak of success, you will continue to be successful. So this is pretty common in bullish markets, and it's similar to what I said before with self-enhancement. The difference is self-enhancement is you give yourself all the credit for everything that happens, and you don't allow any external factors to take credit, whereas the hot hand is simply just, I've been winning, so I'm going to keep winning. It's much more silly, I guess I would say. It's much more of a irrational thought to have that because I made a good investment, I'm never going to make a bad investment, which is insane. Positive feedback. I really like this one because I think this is happening a lot with all the crazy stuff we have in the market, with it being so up and down. People can make money off of terrible decisions and then essentially think that because they made money that it was a good decision and then keep doing that. So the positive feedback loop is the end result reinforces the initial act. I invested in a shitcoin and it made me a bunch of money, so that means doing that investment was a good idea, which it isn't. But if you made money, then you believe that it was, so you're going to keep doing it. And eventually, well, pretty soon, realistically, you're going to lose all that money by investing in terrible random coins versus something actually good and solid that you know is going to be a sound investment. But because you're successful at doing it, you've tricked yourself into thinking that it's a good idea. And this is one of the most scary things to be aware of, right? Because like I said, if you invest in SHIB and you make a bunch of money, now you're thinking, wow, I'm a genius. All I need to do is find really crappy altcoins and invest in those and then just become rich. So now all you do is go around investing in crappy altcoins and you lose all of your gains by doing this instead of realizing that you got lucky, like understanding self-enhancement, realizing that it was mainly luck, understanding hot hand fallacy and positive feedback, that you're not going to keep winning, and that just because you got lucky on a risky asset doesn't mean you're going to keep getting lucky and being successful with these risky assets. So what I always tell my friends who do disregard my advice and just go into something crazy and risky, and they do get lucky, take all that money and put it into something safe. Do not keep playing that game. That is not the way you should go about it. The last one is overconfidence. So again, similar to some of the things that we've mentioned, self-enhancement, positive feedback, hot hand. But this is more so you tend to make choices based on your overconfidence in your own skills or knowledge. People think that they're a genius once they've made enough good trades. But it's more so talking about, like, if you have specific knowledge about something, you might suffer the Dunning-Kruger effect of believing that you know way more because you've scratched the surface. So for example, I know a great deal about networking. So, well, I mean, this isn't a good example because I do know a lot about networking, but let's say someone takes one course on a subject and they know more than everyone around them, right? They know more than all their friends, everyone they talk to in their life. They've never met someone who knows as much as they do about X. And let's just say it was a course on AI. So it is pretty, like, technically challenging, but you barely know anything more than anyone else. You've only scratched the surface. You took one course. You barely know anything more than anyone else. But now, because in your personal life, you feel that you know way more than everyone else because you've scratched the surface and no one else knows even the basics, right? So because of this, you have a very inflated ego of how actually intelligent you are or how knowledgeable you are about this thing. And so you go around investing in stuff like that, thinking that you know what you're doing and what you're talking about, right? Like you know barely anything about AI, but you know some technical terms that other people don't understand. And so you're like, I know about AI. I'm going to invest in this company and this company and this company because I know what's what. You don't know anything about AI or these companies or what they're doing or their technology or their fundamentals. None of that. But because you have that overconfidence, you're bringing that into your investing, and it's going to make you make terrible decisions. Whether it's, specific knowledge or previous things that we've talked about where you're making good bets, it's a bullish market, you're attributing luck from others or, successes from others to yourself, and thus you're very overconfident in your investing. I think mainly the things around overconfidence and your perspective and subjective interpretation of money values and things along those lines, I think those are some of the most important to understand. But a lot of these have their place in what is important and what you need to understand. And this all matters. This is all relevant. There's probably more stuff on Investopedia. But when I went through and I read everything, which took a while because I was also taking notes and everything, this is the summary that I came up with. And obviously I came up with my own examples and stuff like that. This isn't like plagiarism. And I wrote this out in my own words for the most part. But the two best approaches to avoid emotional investing are being diversified and not overly diversified, because some people will get really crazy. I only have like maybe 15 cryptos and 25 stocks around there. So that's my diversification. And dollar cost averaging in, which I highly, highly agree with. That you shouldn't just be saving up a bunch of money and throwing it all in the market. You should just over time slowly be investing into the market. Every time you get paid, take the percentage of your paycheck and invest it. This way, you're limiting your risk because you're doing it over a long period of time. So you're buying the dips and the peaks and everything over time. And it has been proven that typically you're going to make more money by doing this when you're not trying to time the markets, essentially. This is what I've always done. This is what I've always recommended. And it's been proven to be the best performing portfolio strategy over a long period of time. So this is what I'm doing. It's working. This is what is generally recommended as well. And if you're interested in learning more about specific fallacies and things and how this can mess up your thinking, I really, really endorse learning and understanding logical fallacies and biases. I used to do a huge series. I think I did more than 20 posts where I'm just going through and summarizing 5 different fallacies every week. And I think I did 20 posts and then I stopped doing it so I could mainly just focus on crypto and stuff. But I used to be really into that. I'm still really into philosophy and how we form thoughts and learning about all this kind of stuff. But the best way that you can prepare yourself for even just going out in the world and ensuring you're not making mistakes and understanding your own biases and things so that you can make better informed debates and arguments and claims, and understanding your own thinking and how other people might get messed up in their thinking with logical fallacies is very, very beneficial to everyone. A few more notes. In a perfect world, the rational and logical investor would believe in the efficient market hypothesis. This essentially just says that all stocks are valued accurately based on the information we have available. Unfortunately, that's not true. That's not the reality, rather. People's biases, behaviors, and all these different things get in the way, and we end up with a somewhat irrational market. If anything, the efficient market hypothesis should just be what we strive for. And while the market can be irrational, you can minimize your risk in many different ways by following this and understanding all these different things. The most effective way to defend against all of these things, right? The simplest thing that you can do is, before you get into any of these kinds of things, you got to ask yourself, what makes me special? And I don't mean how am I special? I mean what makes you so special? Right? When you're looking at the markets and everything's going crazy, 90% of day traders lose all their money, and you think, you know what? I'm going to start day trading. I think I can beat the system. You stop and think, what makes me special? Why am I going to beat the system? It's well, I'm a new investor and I have no experience. Yeah, what makes you special? There's no way you're going to beat the system. You're probably going to lose all your money. And I don't mean this to be in a mean way. It's just a very simple question to ask yourself to level set and to be rational before you make a potentially big mistake. There's so many behaviors and traps and all these things that are going to be against you. The best thing you can do is just stop and remind yourself that there's all this stuff that you are doing against yourself. And just remind yourself, asking the question, what makes me so special that I'm going to get the best situation here? What makes me so special that I'm not accidentally being tricked by herd behavior or by any one of these traps? What makes me so special that I can't fall into the same traps that everyone falls into and everyone is affected by? Use that to just bring you back to a rational ground and maybe come back to this and look at these and see, am I suffering from any of these? Or am I doing any of these? And likely we all are probably doing some of them, but we don't want to admit it, right? We'll rationalize it away as to why this isn't the case. The most common that I see is mental accounting behaviors, because people are really good at rationalizing this away. It's like, oh, well, it's just, such and such. I can make that back in a day. That's only 4 hours of work. It's only $100. It's like, yeah, you could say that till your face is blue, but all that money does matter, and that time you spend working does matter, and everything that you do, you want to be able to set yourself up in the best way possible in the soonest amount of time. So making all these little silly bets and gambles, and oh, it's just $60, it's just $50, you're just making it take longer to get to that retirement point, or that point where you defined as success. You're just making it harder and take longer and longer every time you do that. Every lottery ticket you buy is actually a delay to your success and becoming rich and becoming, financially independent. Not a chance to become financially independent. It's another delay to your journey towards success. That's the way you got to look at it. Remember, none of this is financial advice. This isn't to discourage you. This is really to just help you guys know what's out there and what you are doing to yourselves, and just be mindful of it and be able to combat it. This was a very, very long video, but it was extremely comprehensive and in-depth, and I think this is going to be one of the most important videos I put out all year, barring aside my reviews and comparisons for social platforms, exchanges, wallets, and services, which is coming very soon. I'm going to be recording a bunch of guides first. I was going to originally do my big release on my birthday in a few days, but I've decided to instead get out a bunch of guides first that I can link back to, essentially. So I might not get it out until February, but I'm going to be really, really getting focused and trying to churn out as many guides as possible so that I can get that stuff out for you guys as soon as possible. So do stay tuned for that. And let me know, have you been affected by any of these traps? Have you ever fallen into any of these emotional biases or anything like that? Do you think investing is more about understanding financial psychology, or is it more about valuating companies and stuff? Are you more for the efficient market hypothesis, or more in leaning towards that, the market is decided by trends and people's behaviors and stuff? Or like, is it a nice mix of the two? What do you think? I've always leaned more towards, while it is both, I'm going to invest based on the market efficient hypothesis, because I can't try to guess what people are going to behave like, or try to catch those trends, or try to do technical analysis, all this nonsense. I think it's much better to just focus on what is objective, minimize as much risk as possible, and just focus on the really quality stuff and not trying to catch the 100x. So that's everything for today. Let me know what you guys think in the comments below. And since you watched to the very end, do let me know by commenting #1ham in the comments below. And that way I know that you watched the whole video all the way to the end, this extremely, extremely long video. And I really, really appreciate it for those of you who do. Thank you so much for watching. I'm Scott Cunningham, aka Scottsy Business, signing off. Cheers.